Greg Foss, thanks for joining us and welcome.
So nice to be with you guys. Thank you for having me.
Well, just to let our listeners know, the reason why I reached out to you to get you to chat with us today, you wrote a really interesting paper that talks about a lot of the themes that we talk about in New Money Investor. And given your background in the traditional financial system and the fact that you have had a long history in credit markets and you've experienced the global financial crisis firsthand and saw the deterioration in the traditional financial system that's given rise to this sort of new crypto market, I think, we're going to have a really interesting conversation today. So why don't we just start with a little bit of background of your history and how you came to sort of be where you are now with this sort of passion for Bitcoin and crypto.
Sure. Well, again, thanks for having me, guys. I'm looking at Jason's little moniker here on our thing. I hope that says Fat Tail Investment Research. Is that what it says?
It does say that.
I love you guys because that's what you search your whole investment career for. All right, the fat tail. So we'll get to that. So my career. I'm 58 years old. And I'm a Canadian who grew up in Montreal. There's a university in Montreal, which is pretty, actually quite world renowned. I'm not sure we had that many Aussies. I know we had more than one or two, but didn't draw that many guys, but draws a lot of people from around the world, particularly in their medical and engineering schools. So I was lucky enough to get accepted in that school in 1982. Hometown boy, but I went there primarily not to study engineering. I was actually playing sports. So I studied engineering, and that's really key because while I knew I didn't want to be an engineer per se when I graduated, I really enjoyed the mathematical complexity of the study of the subject. I was a decent student. I was not a Michael Saylor rocket scientist engineer. I need to clarify that because certainly Michael Saylor is the type of guy who can speak rocket science. But the beautiful thing is he can actually speak normal. He's eloquent in his normal prose as well. Whereas most rocket scientists that you encounter in life are they're walking mainframe computers, right? Like they're like very, very hard for them to put a full sentence together. So we're blessed in the Bitcoin community to have Michael Saylor. But back to me, 1986, I'm about to graduate from McGill. And I realized I really don't want to be an engineer, but I'm not certain what I want to do. And luckily I had enough money to apply to one business school in the United States and a couple in Canada, but I really wanted to go to the US to experience a different culture. And it turns out I was accepted at a school in upstate New York, but it's an Ivy League school. It's called Cornell University. And it's an amazing school that I would not have been accepted at if I was an American because I didn't have the work experience. But given that they were trying to build an international business school at the time and wanted international students, I guess this clown from Canada named Greg Foss was accepted. And gosh, I'm so thankful for that because I got to go to school with some really amazing people, got to experience a different culture. And until you live in the US, you don't really realize the difference between Canadian and US culture. And I'm going to probably extrapolate that to the same thing with the Aussie. Everyone thinks we're all from the same Western hemisphere, if you will, but there are subtle differences, and in some cases, really, really large differences between our beliefs and our cultural system. So very valuable living down there. I did have the opportunity to work on Wall Street right out of school, but I had decided to come back to Canada. And actually, my hometown of Montreal still had the head office of the Royal Bank of Canada, which was Canada's largest financial institution at the time. And the cool thing was, it's my hometown. I felt that I wanted to come back and help set the world on fire from a financial perspective. Okay, a young kid full of pea and vinegar, right? And you're going to do something really special. And I was working for a special projects group where I was working directly for the CFO of the bank. And at that time, 1988, global money center banks, and I'm certain that there's some Aussie banks that were in this same predicament, had made large amounts of loans to lesser developed countries in US dollars. And these countries defaulted on that debt because for a number of other reasons. One of the reasons was the US currency strengthened versus theirs, and they had to pay back US dollars. They couldn't afford it. And so Royal Bank of Canada, Canada's largest financial institution, had about $4 billion. And this sounds like such a minuscule amount in today's numbers, but at the time, $4 billion was a ton of debt or a ton of loans that they had made to lesser developed countries. Now, these LDC countries were primarily in South America, but they did actually include countries like the Philippines, Vietnam, Thailand, some Southeast Asia exposure. But to make the math easy, the basket of these of these loans traded at about 25 cents on the dollar, which meant if Royal Bank of Canada had $4 billion of exposure to these countries, if they were to mark to market their exposure, meaning to write off 75% of that loan exposure, down to from a $4 billion exposure down to a $1 billion net trading level, the $3 billion write-off would have vaporized their book value of equity. All right. Yep. So here I am, I come out of school. I'm like, all right, let's set this world on fire. And I realized that Canada's largest financial institution is bankrupt or insolvent, to be exact. Okay. Insolvent. Negative book value of equity on a mark-to-market basis. And that's why in 1988, Treasury Secretary Nicholas Brady proposed a Brady Plan for the country of Mexico, which was one of the world's largest borrowers. RBC had about $1 billion to Mexico. And he said, okay, we're going to restructure this debt. We're going to change it from a 5-year term to a 30-year term, and we're going to back it by zero coupon US Treasury notes, therefore guaranteeing that the 25 cents on the dollar would accrete to a value of 100 cents on the dollar. It was accounting gimmickry so that the global financial system, so while RBC, Royal Bank of Canada, was in that boat, so were all the New York money center banks, okay? Chase Manhattan, Manufacturers Hanover, Bankers Trust, all the big banks that are no longer exist. They've been combined with other banks. And then I'm going to throw this out that, the large banks in New Zealand and Australia were in the same boat. Although I can't guarantee it, I'm almost certain they were, because global banks all move in the same direction at the same time. So this Brady Plan was instituted. The banks did not have to write down their loans to market because there was a high degree of certainty, if not almost 100% certainty, that a zero coupon bond would accrete to 100 cents on the dollar value over 30 years. It was quite an ingenious proposal, but I sort of looked at this and I'm like, wait a minute, this is how the financial system works? Is it possible that this happens on a regular basis? And in hindsight, absolutely, it happens on a regular basis. But that was my first introduction to what I will term the fiat Ponzi, because how do regular retail investors and savers have confidence of putting their savings account in a banking system that is regularly or could be regularly insolvent if there wasn't a de facto put or backstop by the federal governments of the various nations? And that's how the banking system works. So think about, how does a government backstop their banking system? Well, it's the ability to print money, right? So I was questioning the system back in 1988. I didn't have the solution, but it was always there. It's like, okay, how does this work? Okay, I understand you need the confidence in the system. But back then, total debt and leverage ratios were still manageable. Well, let's fast forward to where we are today, but I'm going to jump through the different financial crises that I've lived through, including 1998, which was the long-term capital management scenario, where losses on Wall Street were socialized to protect crony capitalism, or the people on Wall Street that made stupid risk-adjusted investments and yet didn't suffer the losses because they were bailed out. So that was the first one. The next one was in 2006, 2007, 2008, 2009, the great financial crisis. And even then, we had a chance. And when I say we, I mean the global banking system had a chance of actually, while the Feds and the central banks did backstop that with all the debt they issued, there was a chance at that point, if we had been frugal in our debt policies, we could have paid down the debt to a manageable level. The problem is, every time the Fed tried to taper and central banks around the world tried to taper their quantitative easing, the equity markets got, shivers and a little bit of a tantrum followed, and no one had the guts to follow through with it. Well, the unfortunate part is 2019, 2020, COVID happens. We haven't paid down or reduced our leverage in the financial system. And then insanity prevails, where I'm not arguing the need to protect and to care for your less privileged within a society. The problem is when you do it without regard for what the future holds. And we have now reached the point of no return from a leverage perspective in the financial system. So consistent crises are always transferring leverage from the financial system onto the balance sheets of the governments. Well, if you don't pay it down at a government level and you continue to absorb the over leverage of the financial system to protect things like equity markets and consumer confidence and all that, it's over. Okay. So I can't say it any other way except that it is 100% certain that because of our money printing and because of the debt leverage that we have incurred globally, fiat currencies will debase at an accelerated rate going forward. So fiat currencies have always debased, but it's been manageable. But now it's not manageable anymore. It will continue to debase, but at the second derivative, acceleration, is increasing. And that is a very scary, but a very real problem. And investors need to protect themselves against that. So long story short, it took me about 30 years. I was a high yield credit trader for most of my life. I've worked on both the buy side and the sell side of the street. The buy side, 2 different hedge funds. The sell side, I was a high yield trader in New York as well as in Canada for Canadian high yield credit. And, I bring a different perspective to the analysis of what is Bitcoin and what it offers in from my understanding and my experience in the markets.
So just on that, you've spent a lot of time or have a lot of experience in credit markets. The Fed in 2020 actually went into the credit markets, I think, for one of the first times to try to stabilize things there. And one of the comments in your paper was that the credit market is the dog and then it wags the tail of the equity market. Maybe you could just give listeners a bit of an idea of what the credit market actually is and why it's so crucial to the functioning, especially in terms of the signals that it gives off. Because I think the credit market sort of goes unnoticed a lot of the time. We look at sovereign debt and people understand what sovereign debt is. And then most people are involved in the equity market. So their understanding of what the equity market is. But the credit market is this place that sits in the middle. And it's I don't think it receives the attention that it deserves in terms of the importance that it has to the financial system. Could you give a few details there?
Sure. What a great question and what a great way you framed it, because, it is true. Okay. Firstly, credit is very misunderstood. It tends to be math intensive, and that scares a lot of people. But the good thing is when it's math intensive, you can prove out your theory because everything's a contract. There's no subjective nature to a bond contract. All right. It's not like the coupon on the bond changes if the credit quality of the counterparty changes. The price of the bond can change, and that's what adjusts, but the coupon is fixed. That's why they call it fixed income. Okay. Because the coupon is fixed. So let's state some truisms. And this is about credit. It doesn't matter whether it's corporate credit, high yield credit, state, municipal, federal government credit. I'm lumping it all together. So credit is the grease that lubricates the global financial system. Okay. Capitalism is built on credit. It's built on leverage. It essentially is built on asset values that need to increase so that those collateral values in the financial system support a degree of leverage in the financial system. Okay. Our banks are 15 to 25 times, depending on the bank, levered to their equity base, to their risk absorbing base. That's a massive amount of leverage that the common person doesn't understand. Henry Ford said 100 years ago, he said, if the American public understood how banking really worked, there'd be a revolution in the morning. Okay, so firstly, credit markets have a prior claim on the value of an asset versus the equity holders, which is to say that unless the debt that you've lent at 100 cents on the dollar is worth 100 cents on the dollar, the equity of that same entity is worth zero. Okay, people need to understand that. So that prior claim is very valuable in certain cases, but it's also asymmetric because equity holders accrue all the upside. If a company is doing really well, the company doesn't turn around and tell its bondholders, gosh darn it, I'm doing so well, I'm going to increase the interest rate on your contractual obligation. No, those excess cash flows accrue to the equity holder. Now, the flip side is if you've made a loan, let's just say to a company, and the coupon is 6%, and that company starts doing less well, or the projections were optimistic, meaning their free cash flow or their cash flow is coming in below expectations, that coupon is still 6%, or the semi-annual coupon is still 6%. But what happens is the bondholder needs to receive a higher risk-adjusted return, and therefore you drop the price on the bond so that your overall IRR, or your yield to maturity, adjusts upwards, meaning the price of the bond goes down. So never forget that as a prior claim in a capital structure, a bondholder tends to sniff out negative news.
I hope you enjoyed that preview from New Money Investor. To get access to the full video and much more, please click on the link below.